Hello, guys. Welcome back to AWM FX. Good morning, good afternoon, good evening, or good night, no matter where you are. So, welcome back to the second chapter, all right, of this mini series of S and D, supply and demand, from zero to everything, or from zero to 100. So, this is the second chapter and one of the most important chapter. So, still the same. It's all towards the basic, and we're slowly gaining the momentum, and then we'll talk more about the things that you guys waiting for, the QML, the other setup, the compression, the fake out, or and other things, of course. So that will be in next time in near future. So this chapter will be mainly on trend. All right, market structure, the price structure. So first of all, of course, I assume that a lot of you have gone to some website like babypips.com and learn those basic theory about what is a market structure. How do you determine an uptrend, or how do you determine a downtrend? So easy, it's very easy. We use the most basic is using what we call it high and higher low. All right. So high low, and lower low, lower high. All right. So first of all, let's give you an example over here. Is that let's assume that we have a uptrend. All right. The price is moving, going up. Then what happened was that the price create a low and a high over here, a low and a high over here. Then, like every price, it does not move in a linear. Linear means that it will not move straight. So what happened is that you'll hit something like a ceiling, then it will bounce back. All right, it will bounce back. And what happened is that this is something we call it as a higher low. All right, we or short form HL. Once the price move beyond the high over here, so it creates a higher low HL. All right. Then of course the price keep moving higher high. The next uh level will be high, and then retrace higher low, higher low, high. So this is how the basic we determine the trend, an uptrend, a bullish trend. All right. And of course, the example of the downtrend is that once the price move below the previous low, all right, it breaks the structure, and this is what we call it creates a lower low over here, LL, short form. And once the price retrace and goes beyond again, it creates another lower low. And similarly, like the high and the bullish, this bearish form is using a lower low and lower high. All right. Keep this in mind. This is the most basic that you know. All right. This is the most basic. All right. So if you know what is an uptrend and what is a downtrend or bearish, is that ultimately how you're supposed to trade? No. It's very important to identify that whether you're in a major trend or you're in a minor trend. All right. So basically, I have an example over here. What we are looking at is a USD versus a Japanese yen daily chart. All right. So remember, we have a lot of time frame. We have a range from. I mean, we are not talking about those strange time frame. We're talking about those basic time frame, like, all right, from the most lowest is 1 minute, but which we don't use at all. All right, it's too small, too precise for me. Uh, we'll start with M5, M15, M30, H1, the 1 hour chart, H4, the 4 hour chart, daily chart, weekly chart, and of course, there is an ultimate monthly chart and yearly chart, which we don't use also. All right, the most we goes into is the weekly chart. All right, so if you can look at it over here, I'm talking about what we are looking as a USD daily chart. So you have to imagine every single candlestick over here is representing a daily movement of that particular market for that day. So if you break into example, if you break into a small time frame like M15, right? M15, it will become another thing. All right, that is what we call it as a minor trend, and this is the major trend. Then, of course, in this major trend, I'm going to explain it very slowly. So, in this major trend, you can see that there is a three type of movement. The most basic movement. All right, The first movement is, of course, you know it as a downtrend, bearish trend, or the drop. All right. And the second one is the sideway or the base. And of course, the third is the bullish uptrend and or the rally. All right. So we explain slowly by slowly. If you look at this major trend right here, you can see that the price keep breaking the structure. All right. Previous low, and then it retrace and then break again, retrace and then break again, and retrace and break again. So this is a very, very, very obvious downtrend. Similarly with the uptrend, right? It broke the previous high over here, and then it retrace, and then it break again the previous high, and then it retrace, and then it break again the previous high, and then it retrace, and then maybe it's moving sideways, right? Which I'm not going further in there. And of course, what is a sideway? Sideway is actually the connection between the bearish and the bullish. All right, so this is a very, very small sideway. Sometimes the sideway may goes for a lot more candlestick. Like I'll say that it's a very big candlestick, bigger zone than this. All right, so this is what we call it as a major trend. All right, so what is a minor trend? Like I explained earlier, each candle represents a daily movement of that particular currency pair. All right. So this is a downtrend. You can see that this is major downtrend. But if you look at this small area over here, all right, this small area over here, and if we focus it into a smaller time frame, like M5 or M15, all right, or even H1, what does it look like? It looks like an uptrend. All right, it looks like an uptrend. And you'll be talking to yourself, oh, the trend has changed. It has gone from downtrend to uptrend. But in the major trend, it's actually going down some more. It's just a retracement. And the most important things here is why is it important? Why you should identify what trend you're in, the major or the minor, is that you must know where your situation or your position is. How risky is your trade? You have to know a lot of things, all right? From there, from this kind of identification of major trend and minor trend, you can reduce your risk of getting huge stop loss. This is the first thing. And second is that you can ride with the wave. Sometimes this is what we call it, ride with the wave. Let's assume that you were able to caught some nice movement from up here, all right, a sell. And if you look at the major trend is going downtrend, then you're riding a wave. This will be huge, huge, huge. All right, this will be a very huge. So, this is another explanation like what I told you just now. The major trend, the minor trend. All right. So in every major trend, there is always a minor trend of its own. All right. Okay. All right. So example here, if you can see that this is exactly the same movement as previous. You can see that there's a downtrend, there's a base, there's an uptrend, there's a base, there's a downtrend, base, uptrend, base, downtrend, base, uptrend, base, downtrend, base, uptrend. All these uptrend, small uptrend, does it mean that you have to avoid? It depends on your skill. All right, it depends on your skill, how familiar with you, how familiar of you with trading. All right, because this movement over here, all right, this is daily chart. 1, 2, 3, 4, 5. Example, 5 days of movement. It is 1 week of movement. All right, you can see it's a 1 week of movement, and this 1 week it contain a lot of pips. But just that you have to keep in mind, overall is going down. That's all. So you have to be very cautious, or you have to get out from the trade when things goes wrong, or take your profit early to prevent all this sudden change of drop. Then you'll get surprised. You say that, hey, how come it has broke? Maybe in 50 minutes, it has broke the previous structure. It's supposed to go uptrend, right? Yeah, it's supposed to go uptrend in small time frame, but not supposed to go uptrend in a major time frame. Right? Hopefully, I don't get you guys too confused about this, because this is very, very important. Every time you trade, you must know which time frame you are looking at, and of course, you have to counter check with bigger time frame to know that your position, what is your position. All right. And not only that, all right, a lot of people will ask what kind of time frame you should look at. All right. Should I look at H1 or should I look at H4 or even should I look at day one? All right. I cannot answer this for you. Reason is that the way you trade and the way I trade is different. All right. I may be very busy, so I will just look at H4 and daily chart. And I only trade 3 to 4 times per week. All right. In a normal situation, when I get the confirm, very, very confirm trade, then only I go in. That's how I trade. But some of you might be looking at future of becoming a full-time trader. So if you look at H4 and day one, you get bored easily. Right? All this small, small movement is for the full-time trader. This is for you. Or maybe smaller time frame, M5, M15, you even get how should I say, you even get more opportunity, right? But should you trade more? It depends on your lifestyle, your trading way. All right. All right. So I'm gonna spend a few more minutes. Just bear with me to explain more about the major trend, the minor trend, because this is the concrete foundation of all your trading. All right, of how you should be trading, or how should I say, how you should be riding the wave, right? So we'll just look at the USD JPY daily chart again, but this time it's more in recent time. All right. So what happens is that you can look at it very, very obvious over here is that there is a downtrend, there's an uptrend. All right, there's a downtrend, there's an uptrend. Of course, this is daily chart. So I'm gonna highlight some area for you. All right, I'm gonna highlight some area for you. So let's assume this. We know that this is a down uptrend. So let's highlight this area, and let's go into smaller time frame. All right, let's go into small time frame. Let's look back at this area. Right. Maybe I'm gonna make a replay over here. Right. So if you look at it properly, right, you know that it's an uptrend in the high time frame. Of course, when you switch it to high time frame. But some of you are too obsessed in whatever time frame you're trading. Maybe it's a M30. M30. All right, M30. And you saw this movement over here. All right, you saw this movement over here. You can see that the price is moving up and then drop or break of structure. Good. Then it comes back to the top and then it goes down again. All right, this is a classic QML trade, which will get more involved in it in the near future. All right, in maybe in a few more chapter. So yeah, you can catch a nice trade if you're intraday trader. You can see that you can catch a lot of pips from the top maybe to here. It's 123 pips, which is very, very good, isn't it? But the problem is that you always need to counter check. All right, you need to counter check to a high time frame to know whether you should be riding the wave or you should be very cautious. Right? If not, you got caught at the bottom here and then the price keep moving up and you'll be cursing. You say that how come it's supposed to be downtrend? If you look at it, it breaks a lot of low. It breaks a lot of low over here. Can you see? All this low has broken. It's supposed to go down. It's supposed. There is nothing as supposed. If you don't switch to high time frame and look at it. Can you see? There's always, of course, there's always opportunity to trade in lower time frame, but just that you have to be sure which or what position you are in. Hopefully, I really hope that you guys get more clear picture on this because it is very, very important. A lot of people ask, how come it does not reverse at that area, or how come it just reverse a bit and not go down some more? It's because you're on the opposite side of the trend, of the big trend, the daily trend, or the H4 trend. All right, you're at the opposite side of it. Right? Can you see that from daily, it has broke the previous high. So it goes up, retrace, goes up, retrace, goes up. And you cannot just look at this movement and say that it's going down all the way. All right, clear? Clear, we'll move on. Of course, there is another way of looking at the trend, which is using a block method. We call it the block method. That not going to share it over here. It's meant to be for, I'll say, exclusive, exclusive way of looking at it, which is very, very effective. I found it that it's so effective that I cannot expose it openly to everyone in YouTube. All right. So let's go to the next chapter. A lot of people will get very confused. Hey, I thought this supposed to be a supply and demand. How come suddenly this AWFX talk about support and resistance? It is because support and resistance is actually related with supply and demand, right? I'm gonna explain it slowly. I'm gonna bring it into in depth of everything. Then maybe in the very very last chapter, I don't know how many episode I'm gonna make. The very very last chapter, I'm gonna clear up all your doubts, and I'm gonna clear up all whatever how to say things that is clutters in your mind. I'm going to clear everything, then you can see the whole picture very clearly. And hopefully you practice, you look at the chart more and you know. All right, so support and resistance, those newbies, the most basic support and resistance. What the heck is it? All right, support and resistance is the price that rebound at the top is called resistance, which we also call it as a ceiling of the price. Right? And the price that rebound at the bottom is called support, which is the floor of um the floor of the price. All right. So it's very simple. The price is moving up, and that is the resistance when it hits something. And when it comes back down and hit something, it is a support. Similarly, for a downtrend, it's the same. All right. When it goes down, it hits some floor and then rebounds back. All right, as a support, and then hit a resistance and goes down. So this is how I learn, and of course I'm going to share some idea how you're going to memorize support and resistance. I won't say memorize, you understand support and resistance. So just imagine yourself staying in a multi-story apartment or condominium or luxury or whatever it is. All right. So you have on your hand, you have a very, very bouncy ball. All right. This ball, there is no loss of energy. All right. I'm not going very engineering here. Uh, this ball will not lose any energy. Means that if you throw it, it will keep on bouncing. So same like a price. It will keep bouncing on the floor and to the ceiling, back to the floor to the ceiling. What happened is that suddenly on top of your ceiling, there is a hole. All right, on top of your ceiling, there is a hole. So this ball went through the ceiling. All right, went through the ceiling. And what happened? It went to another level of bouncing. It went to another level of bouncing of support and resistance, where this resistance, all right, the ceiling has become your support. All right, the ball will bounce and bounce and bounce. And similarly, if the floor has, all right, if the floor has we call it as has a hole, it went through, then it will keep bouncing again. All right, where your support has become a resistance in this case. So it is very, very easy to understand, and this is a simple explanation of what is a support and resistance. So why does it happens, or why does it occurs support and resistance? This is because of a psychology factor. We call it as a price anchoring. All right, I'm going to tell you a very simple story. So imagine, I believe a lot of people have McDonald's in your country. I believe so. A lot of you that watch this video have McDonald's in your country. So what happened is that if you are a regular McDonald's customer, you know how much does a Big Mac price is. Let's assume we are using USD to have this price anchoring as an example. Let's assume that it costs $10. Regularly, when you buy the Big Mac is $10. Then suddenly after 1 month, you didn't visit the McDonald's. You went back there and you buy the McD. Then when you pull out the $10, the cashier told you, sorry, we have the price now is $12, right? $12. So in your mind, you do you think that the price has increased or decreased? Automatically, you know the price has increased. Why? Because in your mind, you have anchored a price at $10. And now let's assume that another situation, you went back to the same McDonald's and bought the same Big Mac, but this time the cashier told you, when you pull out the $10, the cashier suddenly give you back $3 and tell you the Big Mac is $7. So automatically you know that the price has reduced. All right, this is what we call it as a price anchoring. Same with support and resistance. Why some price particularly it will bounce at that zone. Remember, it's not a line. Support and resistance not a line, a zone. Why at that particular zone? It's because big players, big bankers, they have price anchoring in their mind. They know where to play about with the price. Right? They know how to manipulate price at that particular. They know that at that particular place, a lot of people have pending orders because sometimes it may be a round figure. All right. Hopefully, I don't get you guys confused. All right. It's just a simple explanation. Just absorb, whatever it is. Then, if you think that what I'm talking about is a bit of bullshitting, then just forget about it. But this is really what is happening. Price anchoring. All right. So, how do you mark support and resistance? Right. A simple chart. I'll tell you. If I close your eyes, I ask you to put random line. Every line will touch the support and resistance. Right? It will touch the support and resistance. But which one is the correct one? So I'm going to give you some guideline. So the first guideline is that it is possible to mark at all time frame. But the higher the time frame it will give you more accuracy reading. So of course, the higher time frame here, I'm talking about the H4, the daily chart and the weekly chart. All right. And another way of marking the support and resistance that don't mark too much of line. You'll get yourself confused. Mark at the most recent price. I'm going to show you. Don't worry about that. So the second is that always mark at the extreme high or low of a trend. So when you mark at the extreme high and low of a trend, where the price bounce the most, that is the most accurate support and resistance. All right, that is the most accurate support and resistance. And of course, you have to mark at the shadow of the candle. Sometimes it might be at the body. All right, you mark at the shadow where the rejection has occurs the most. And always mark at the extreme open and close price, depending on the movement. I'm going to explain slowly. So for beginners or for those that unsure what's happening, all right, use line chart. We have a lot of type of chart. We have bar chart, we have candlestick chart, we have line chart. Use line chart for initial marking, then switch to candle chart to adjust your support and resistance line accordingly. So what are you looking for in a line chart? You are looking for a V shape or an A shape. All right, a V shape or an A shape. That is where the price rejects the most strongest. So when I go into the chart, all right, when I go to the actual chart, it is not like what I've drawn just now. Simple line going up, going down, right? It becomes very, 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 very messy. You can see that the price is all over the place. So now let's assume that I do not look at over here. I just look at this blank area. All right, I just put random line. I just put over here. Maybe put some over here, or maybe some over here. I can assure you, when I look back to the left-hand side, I will definitely touch a lot of support and resistance. All right, let's go back. See, so accurate, so accurate. Like all my line, it definitely will touch something and rejects on something. It's so accurate. But in actual, what am I doing? I'm just drawing random lines, right? So this is not the correct way of determining a good support and resistance. All right. Of course, I told you before, the most basic one, switch it to line chart. Now, when you switch it to line chart, what are you looking for? You're looking for the V or A shape, a very, very sharp V or A shape. Example over here. Can you see a very sharp V or A? Just put the line over there first. Don't worry about that. V or A. Just put some line, right? So this is what we are looking for. And particularly sometimes it hits a lot. All right, which I'm going to explain very fast. So we just look at some of the trend, downtrend. Yep. So this is a very, very strong support and resistance. All right. Then what you do is that you switch back to the candlestick and you adjust accordingly. So from here, you can see that the price is rebounding more particularly on this zone rather than the random line that I drew just now. It's more accurate in this form. Can you see it? It's more accurate. So this is an example of how you can draw your support and resistance using line chart. Determine where is the sharp B at the trend, all right? The movement, the ultimate movement. If you look at it, high, low, higher high, lower low, then the break. Can you see it? Sharp area. We look at the sharp area. All right, so this is a example of how you determine support and resistance. And not only that, what I have drew just now, all right, what I've drew just now is something that we call as a significant support and resistance. Something new, right? Significant support and resistance. It's not normal support and resistance because there can be a lot of support and resistance such as like this over here. There can be some over here such as like this, right? But what we are looking over here is that a very significant support and resistance. So what is the criteria to become a significant support resistance? Not a normal support resistance, right? Significant. We call it SSR. You need to have a lot of rejection. It does not matter whether it's from the top or from the bottom or combination of both top and bottom. All right. Then it has become a very strong price anchoring, significant support and resistance. And the way we trade supply and demand are using this SSR, significant support and resistance. Of course, for significant support and resistance SSR, I have my own definition, which is very easy for you guys to refer to. All right. So the first definition of a SSR is that it is if it's a single candle, it has long shadow. So what does it mean by long shadow? Means that there is a very, very strong rejection. It does not matter whether it's from the top or from the bottom. All right, it's from the support or from the resistance. So if it's a single candle, it has a very long shadow. So second is that the criteria is that if it is a multiple candle, all right, if it consists of multiple candle, it has to be retest with minimum 2 or at least 2 at almost the same price. Remember, significant support and resistance is not a line. It is a zone, but it depends on how big the zone is. All right. All this is all about your experience. All right. Backtest it more. So not necessarily all retest is at extreme high or low. So this is very important. Sometimes it's not at a single candle. Sometimes it's with multiple candle. So here we're gonna have another example. So if you look at it, of course, like what I said that usually we'll do it at the extreme high and extreme low. So in this case, if you look at this, is what we call as a significant support and resistance. Why? At this area, extreme high, extreme low, you can see that there is a multiple rejection, right? Along this line. Yeah, there is some protruding out, going up, going up. It does not matter. So along this line, there is a significant support and resistance. And if you look at it, a single candle. So example like this single candle, that is a very strong rejection. So I didn't draw it over here. This is also a significant support and resistance, a very strong rejection from the bottom. All right, so this is an example. So how do we use our SSR in the supply and demand trading? All right, so the first one is that we use it as a support become resistant. SBR, or resistance become support, RBS, is for trend continuation trades. All right, this is introduction, right? Introduction about SSR. So first is become SBR or RBS. So second is as a place to determine Quasimodo level. All right, this is the one that a lot of you are waiting for. It is a place to determine Quasimodo level, QML, for role reversal. All right, so trend reversal trades. So this might be also a trend continuous trade. It depends at what trend, minor or the major trend. All right. So the third is that as a line to determine a fake out to avoid big trader manipulation. Right. So this is the usage of SSR in our trading. Of course, I'm going to explain it further in the next video. This video, I believe, has dragged over 20 over minutes or 30 over minutes. So in the next video, we will going to have our first type of setup. All right, I promise you, I go in depth how to use the first type of setup. That is the support become resistance or resistance become support. So before I go into that explanation of the first setup, I will also touch a bit of how we're going to define our supply and demand. All right. When I put everything together, supply and demand and significant support and resistance, we're going to have our first type of setup. All right. So that's all for today. So hopefully I don't drag things too long, and I already try my best to explain as simple as possible so that you guys can catch what I'm trying to what I'm trying to tell you guys. All right. So if you like the videos that I do for you, please do give me a like and subscribe. All right. So I'll see you guys in the next episode, which will be uploaded on Thursday. All right. So see you guys then. Bye.